Hello. Hello, Rashmi here.
Hi Rashmi, this is Ishwari.
Yes, hi Ishwari. Yes, we are just giving few more minutes for everyone to join.
Okay, sure.
Okay, thank you.
Thank you.
Yes, hi Pratik, hi Deepthi. Thanks for joining. We're just giving few more minutes for a few more people to join. Okay, and then Alvin will come over. Okay, thank you.
Let's get some volume.
Hi Alvin, good evening. How are you?
Good evening. I'm doing fine. How are you?
Yeah, I'm doing good. Thank you so much. Nice to meet you. We have Pratik, we have Ishwari, then we have Deepthi, we have Kiran also on the call. Raj is supposed to join in few minutes. He said he's with a client, but he said you can go ahead. So anyway, we are recording the session, so I'll be sharing the recording with few more people if they can't join now. Okay.
That sounds good.
Yeah,
I'll
thank
go ahead
you.
and share my screen really quickly.
Yeah, just a little sound check. Is everyone able to hear?
Yes, Rashmi.
Okay, thank you, Ishwari. Thanks.
All right, let me try to find my documents here. And we have here. Okay. Okay, what we have is an opportunity in Princeton, Texas. First of all, my name's Alvin Johnson. Thank you guys for joining in. I'm the president of Hope Housing Foundation and also Empower Development. And so today we currently have about 1,054 units that we currently own and manage. In the last 10 years, we have gone on and bought 3,500 units of apartments. We have bought and sold and renovated and flipped and value added as many apartments as we could in that time. In the last 10 years, 12 years since I've been the president of the organization. And over the last 2.5, 3 years, we got to a place where I thought, along with a lot of other people, that apartments were getting too expensive to try to buy, and buying old apartments and putting a lot of lipstick on them. And we didn't want to do that anymore. You know, over the last 12 years, all of the units that we have owned and managed have been older properties. So I've got a really good feel for maintenance issues in apartments. My background for the last 38 years has been in real estate. I've owned two mortgage companies. We've built over 100 homes and sold them. And again, the mortgage company, so the finance background has been my primary background, along with renovations. So after, again, 12 years of owning older assets and renovating them and trying to make them nice for people to live in, we decided 2.5, 3 years ago that we were going to go into the development of new apartments. I've built houses before, so I knew that it wasn't that big of a deal. So we went out about 3 years ago now and bought 81 acres in Greenville, Texas, and we developed that into 200 single-family lots that we are in the process of selling right now to LGI. Well, while we own that land, we decided, again, that we were going to build apartments, and I tried to figure out the best way to do so that could be efficient, a lot less maintenance, and that could be a really nice place for us to own long-term with little maintenance. So I started diving into the technology called structurally insulated panels. Structurally insulated panels are polystyrene made out of wrapped with plywood. So if you're familiar with a Yeti cooler, you can put ice in a Yeti cooler and come back 5 days later and you still have ice or very, very cold water. That same technology that is in that cooler is wrapped inside of our wall panels. And these wall panels are delivered and they come out, and I'll show you what that looks like here at the end of this presentation. But anyway, the reason we're using that, again, is for low maintenance, long-term ownership, and efficiency. Because of the efficiency in that, I'll show you how our numbers in our developments are going to make a lot more sense for us as investors, but for the long term of us investors as we do more and more of these units. So this particular opportunity in Princeton started out as an equity raise of $10 million, and we were able to get it down to $4.5 million of total equity needed. Whoa, check that out. I've never done that with this computer. So the total project cost right at 44 million, so 43,375,000. We've got a stabilized value of 60 million, 59 and some change, so right at 60 million. We believe that we'll hit that stabilized value within 2 to 3 years. So we've got an automatic 43 to $60 million. We're adding about 30% in value to this. So this is the same thing as a value add apartment, except we're building it new, and we are receiving the appreciation from the hard work of developing this when it stabilizes. And so you can see our stabilized debt service coverage ratio and everything here. This introduction tells a little bit about myself and my background. Again, the same stuff that we talked about. It talks about the subject property having Class A finishes with smart appliances, LED lighting. The LEED certification is one that we may not go after, but we will be LEED certified ready if we wanted to do that. We will also have indoor air quality plus in the system in these units because of the efficiency and the air tightness. We've got eco-friendly credits that we'll pick up from doing this. Interior corridors, large spacious units, granite countertops, kitchens and in the kitchens and bathrooms. We're providing washers and dryers, not just the connections in each unit. One of the reasons for that is because of the efficiency of the electricity. By us putting in the most efficient appliances, we know that we're controlling the electric bills because we will have a one convenience pay for the tenant. Write us one check, it covers your rent, your lights, your water, your trash, and your cable. And I'll show you why that's so important. And then, so the RUB system is really a utility bill back system, but I'll show you that as well. And then this is a unit mix. We've got some 1s, 2s, and 3s in the development. To talk a little bit more about how we came up with the total capital stack, here's the land acquisition costs. We paid $7.5 million for the land, the legal and acquisition costs. Total construction hard costs is right at $29 million. And then we've got soft costs, municipal fees, interest reserve, developer fees, and all of these fees right here total the 45 and some change. Subject property finance and analysis. This talks about how we have calculated the gross potential rent, what the NOI is, and I can walk through that and show you on my spreadsheet as well. Then our exit strategy, we anticipate lease up about 6 months after the property is fully finished. So that's about 1 year after completion, putting us at about a 2-year, 2.5-year mark. We will then refinance the property after the year of operation, reaching that stabilized value. We will refinance in at 70% LTV for a loan amount of approximately $41 million, which will give us enough to take out the construction loan and pay off all the equity that is placed into the deal by our partners and investors. So the way we did this.
Alvin, can I ask one question here, or do you want me to wait till end?
No, sir, please go ahead.
Okay. So in terms of management of the property,
Sure.
is it going to be done by you guys, or it's going to be done by another company?
We're going to do third-party management with Lynn Management Group. Currently, we manage about 1,000 units, but this is a Class A project, and we want to put this with a top-notch manager. Lynn Management manages about 25,000 units of Class A apartments. They have a big presence in the Dallas area, and so they're going to be our management company.
Okay. And I noticed that you are a 501(c)(3) organization.
Yes.
So is the development being done by your organization, or the development is done by a third party?
The development is being done by our organization. It is not a 501(c) nonprofit deal.
Okay.
So it's not affordable housing, and it is workforce housing, but the affordable component is where we set aside some units for people that make a certain percentage of the area median income. And this project is not that. It's a straight market rate, so it's not going to qualify for us as a 501(c)(3 opportunity.
Okay. So there is no QOZ component, qualified opportunity zone investment as part of this, right?
No, say that one more time for me, please.
So there's no qualified opportunity zone investment component in this.
No, sir. That's correct.
Okay.
This one's not an opportunity zone, and so there are no advantages by having a 501(c)(3) included in this particular transaction.
Got it. Thank you.
Yes, sir. Put my glasses back on. So what we have here is, and this is really high level, and then what I'll try to do is I'll bring up my other spreadsheet to kind of show you some of the back end of this. But what we did was we have, in year one, this is a total of about total equity. I put 4.5, this is 4.8, so it rounds the numbers up. But in year one, we've got all construction, so we've got no distributions or anything there. But what we will have in year one is a percentage of payout of your preferred return. So what we're offering is a 9% preferred return with a 15% hurdle. And what that means is from day one, we will pay a 9% preferred return. And if you'll remember, I showed you on the other page that we had an interest reserve built into our capital stack. That's how we're able to pay these returns before the property is cash flowing. So we'll pay out 9% return in year one. And that is reflective over here in this column. I hope you can see my arrows. And then we will accrue 6%. I mean, yes, the $6,000. And this is based on a $100,000 investment. And then in year two will be up and operational. There will be some cash flow coming into the property in year two because we will start leasing about month number 13. and I'll show you that on my other spreadsheet. But in year 2, we will also be able to pay out the full 15% preferred return because we will have cash flow in year 2. Year 3, we will pay out the 15% return as well. We will also refinance in year 3, this $4,480,000. That's our proposed loan amount right now. That proposed loan amount would pay off the first lien debt, and I believe I said over here it was about $33,947, and it would also provide, so out of $33,440, we got $9 million there. So out of that, that covers all the fees. It will also cover the makeup of the $6,000 that was here, that was accrued. That makeup will come from this number as well. And then there will be about $365,000 of proceeds that go as a kicker. That is over and above the payoff amount and all fees to close the loan. And then because we've hit the 15% hurdle, we split those proceeds with the sponsor and the LPs. And based on a $100,000 investment, there would be about 90, $50,000 units, I believe it totals up to. So your pro rata share on 100,000 would be $4,000 additional distribution. That will bring your total distribution for that year to $19,061 plus a return of your capital of the 100,000. And then in year 4, yes, sir.
Sorry, so I have the question here for the accrual. So
yes.
You mentioned that the accrual of $611,617 will be part of the $4,480,000 in year 3.
Well, you know what, Pratik, this number here shows pref paid of $60,490, $60,490 here, but actually we will pay that. And let me show you where we're going to pay it from. Oops. My calculations of because there's no income coming in, my spreadsheet shows that 611 was accrued. But in this number of the 3,540,000 right here, the interest reserve is where we will actually pay that preferred return from, the 9%.
Okay.
Okay.
Okay. All right. And one other question that I have is year 3, when we are going to refinance, what is the assumption you have made for interest for that refinance? Because interest rates will go up, that will affect your year 4 to year 7 calculations.
Let me pull up my other spreadsheet and let me stop sharing real quick and then I'll show you what I'm looking at. Share screen. Okay. In year, so here's the full-blown model. Okay, so here's all the land acquisition costs, hard costs of everything here. And here's our year 3 loan amount. We're using a 75% LTV. We're using a 4.5% rate, and I'm using a 475 cap rate. Currently, rates on multifamily assets are about 2.875 if I were to refinance this today. So what I've calculated is about a 2% bump, really close to 2% over the next 2 years. Hopefully we don't see interest rates go up that high across the country. But if we do, I have built in that, and I've also baked in a 4%, 475 cap rate. Right now, our market is using about a 375 cap rate. And I'll show you what the difference will do here just by changing the cap rate. So we have a stabilized value of 61 million using a 475. If we use that 5 point, there's already data there. Do I want to replace it? Okay. Oops. Oh, you know what? I hope I didn't mess this up because I don't know that I have Excel on here, but we're gonna try it. Hang on, I'm gonna stop sharing for 1 second. Where'd it go? Where'd it go? Well, I can't find it now. Hang on, let me open my email back up. There it is. Now let me share my screen.
So the cap rate is your loan, your rent to loan ratio, right?
I'm sorry, say that again.
The cap rate, is that the rent to loan ratio?
The cap rate is actually the rate that a cap rate is used by lenders and to measure their level of risk. So, for instance, in this environment, when I said that that lenders are using I'm trying to stop the share real quick so I can see you. When lenders are using a cap rate of, call it 5%, and interest rates are at 3%. And the way that could be in any particular market, just call it Frisco. If we were to step outside of Frisco and go into Oklahoma, the interest rates are the same, but because the market is not the same, the cost of living is different, the economic drivers are different, the area median incomes are different, then a lender may not use a 5% cap rate there. They would use something like a 6 or 6.5% cap rate.
Got it.
And so the higher the cap rate, the lower the value. And so that is how they, again, use that cap rate for a level of measure of risk.
All right, thank you.
Yes, sir. I'm glad I was able to explain it that way. That was pretty good. All right, let me try to bring this back and we're going to share again. Okay. So, okay, let's try this. 475. And you notice a 61, if we use a 5.25 value on the cap rate, oops. Then with a 5.25 cap rate, we got a $55 million value versus a 61. If it trends the way everybody says it's going to trend over the next 2 years using a 3.5 cap rate, we've got an $83 million valuation. And then in year 3, the numbers that we pull out in year 3 are staggering. I mean, in year 3, we pull out $11 million and we'd split that $11 million, and the returns over here go to 69%. It's ridiculous. So I try to stay away from those kind of forecasts because it just doesn't even look right. So I stick with something that is really palatable. I mean, all of our rents are real life numbers. Our appraisals, we've got the appraisals to support the value. And the only assumptions that we make on this are what will the values be in 2 years, 3 years. We've got interest rates ticked up to 4.5%. So even if we go to 5% on the interest rate and we go to 5% on the cap rate, we've still got a $58 million value. If everything went to Hades in a handbasket, we only owe $44 million, including all of our equity. We could fire sell it and get out of it. So these type of manipulation of the numbers, and I hate to use that term, but it's real life scenarios. So today, again, we're at a 3.75 cap rate. I would never predict using something like that, but I'll go up, 1.5 or so just to show 4.75. And There are some other numbers in here that I'll show you that I think are really important. I was talking about the efficiency of these apartments using the structurally insulated panels. And a lot of the efficiency, or a lot of our NOI is going to come from here. I talked about the convenience pay for the resident. So what we're going to do is we're going to charge $60 a month for a washer and dryer. If you have one, we'll buy it from you. We'll pay you $400 for it, whatever it is, but we need you to use ours because we are controlling the efficiency of the electricity. We've got 170 covered parking spaces. We can get $75 for them. We got valet trash service at $25. A few of the tenants will pay late, but the biggest driver here are the utilities of $120 per month for every unit. We have an energy HERS we have a HERS rating from an energy rater that guarantees our utility bills in these units are $544 per year. That includes lights, gas, water, all of the utilities, $544 annually. So that's about $48 a month. Here we're charging $25 for water, utilities. Well, water and utilities are in this. And so we've got a pretty big delta on every unit of about $60 per month. But our income on that is $289,000 a year just on the electric charge. Our cable, internet, we're buying internet from AT&T off the curb for $32 per door for 300 meg fiber internet. Retail for that, if you walked into an AT&T store or called them on the phone, is $75. We're charging $75. Our income from that annually is almost $200,000. It's $180. The $289 and the $289 and $180. That's $460,000 a year that most apartments never ever see because they don't charge that. Guess what that covers? That covers all of our payroll. It covers all of our payroll here. And it also covers our corresponding expenses that go with that. So when we can run this thing with literally no payroll, all of that money goes to the bottom line for us. A couple of other things that we'll look at. The pest control charges, $48 per unit per year. Those charges will be passed on to the tenant. Everybody pays it. And we've got make-ready expense of $16,500 for the first year. These units are going to be brand new. That number will go to the bottom line. We've got repair and maintenance of $20,000 for the first year. That number will go to the bottom line. These things are under warranty for 10 years, everything. If the tenant breaks it, they pay for it. So our expense, we have to show it because the underwriters require us to show it. But those numbers, again, will go to our bottom line. So when we start moving all of these things to the bottom line of the NOI that's driving our values, I'm telling you that we're going to blow these projections out of the water, but I just can't put it on paper and predict it that way because anything could go wrong. But I know that from a practical perspective, we've got a budget from our contractor that will, I say not exceed, they've got force majeure clauses in their contracts and things like that, but we've got a lot of contingencies built in to where our total construction costs, including land and everything, will not exceed these numbers. And that we're very comfortable with. Our contractor is bondable up to $100 million per project. They operate in 8 states and they do about 15 of these types of projects a year. That's why we selected them to be our partner. And they're super excited to work with us. And we've actually already started this project. So we're having the retention ponds worked on now. The final grading is being done. And we're just closing up this round of the investment. The $4.5 million, that was all we needed. We will have, let me see, this is the 1st of February. By the end of this month, all of the final grading should be done. By the middle of March or so, All the retention ponds and everything should be done out there. And then we will be closing on our construction loan, allowing us to put in all the horizontal utilities and improvements. And we are expecting to go vertical with apartments by May or June. And so it's going to be an exciting process. They have told us that we should be able to build this in about 18 months. Actually, they told me 14 months. I'm giving them 18 months. Actually, I'm giving them 2 years. But if they can get it done in 14, 18 months, we'll be extremely excited about that. You know, there are a lot of supply chain issues going on, and we all hear about it. How are we trying to mitigate some of those occurrences for delays? The day we close on our construction loan, we're ordering all of the materials that we need that have a lag time. So right now, windows are like 16 to 18 weeks out. Our structurally insulated panels will take about 16 weeks. Our air conditioners are being manufactured by Detson. Those are about 16 weeks as well. So by stacking all of these things up that we normally could get in 4 to 5 weeks, that are taking 14, 16 weeks, we're ordering on the front end. Even cabinets right now are taking about 12 weeks. So we're just adjusting our timelines for ordering supplies based on the extended delays versus, oh, we need it in 2 weeks and we used to be able to get it. So those are some of the things that we're doing to mitigate those types of supply chain issues. Also, by locking in our pricing when we close on a construction loan, our prices will not fluctuate from that date. We're seeing some fluctuations right now. One thing will go up, one thing will go down, literally every week, but we have not seen any overall cost increase over the last 6 weeks or so, working with our budgets every day. So we're super excited to bring this project to Princeton, and we've got several more opportunities coming in the near future in Anna, Texas, and again in Princeton, Texas, and Howell, Texas, and just all over North Texas that we're going to be working. And we would love to partner with you guys to help bring some of these opportunities to life. So if there's anything more we can do to.
Yeah, so Alvin, just a couple of questions. So for the rental, if it's a one bedroom, one bath rental, what is the total rent, including all the utilities and everything that they will be paying?
Okay, let me look that up.
I'm just trying to get a perspective.
Let me find it. I believe it's about $1,350. I know that our 3 bedrooms are like 18 something. And one of my doctor friends, one of our partners who's a pediatric gastroenterologist, went out to Princeton a couple of weeks ago. I'm looking for I can't find it on this computer. Went out to Princeton a couple of weeks ago to do a survey on units, and he was looking for a 3-bedroom apartment. First of all, he couldn't find any. And then when he finally found one, he went to the last apartment complex that was pretty nice because there's only about 3 of them. He found one for $2,300, and they told him that he made too much money to live there because those incomes were restricted because some of those were affordable apartments. So the market over there with the rents and everything are really changing. Where is my spreadsheet? I am so sorry. Let me open up mine.
And the all-inclusive cost model, is it common now? Because I recall the multifamily rentals where everything is broken down. You are paying your own utilities and rent and pest control and stuff like that. If you're rolling it all in, is that the model that's going on right now?
Most apartment operators are definitely charging for those ancillary services. Most of them are not providing the internet and the utility charges along with the rent because they are not building apartments that are this energy efficient. Most apartments for a 1-bedroom apartment, my daughter lives in a nice one here in McKinney, and her light bill in that 1-bedroom apartment is $118 a month. And I'm like, whoa, that's $1,200 a year. We've got a guarantee from our energy rater that our utility bills, including water, won't be over $500 per year. including water. And so big difference. And I believe that, we're doing this. Princeton is, I believe it's going to be a young family town. You've got a lot of new houses there. You don't see many yet, $500,000, $400,000, $500,000 homes there. So this is going to be more of a blue collar, gray collar working environment. And I believe school teachers and people that work at Walmart and everything, they're paying this kind of money to live in these apartments already. And if we can just provide them a little more convenience with a better quality of living by making these A-class units, I believe we'll be top of the market, first in class. When I say we're making them A-class, it's easier for us in the long run to make these apartments top-notch finishes with smooth surface countertops and things like that, because it's a lot less maintenance going forward. You put in Formica countertops today and somebody move in there and start smoking. When they move out, they burn holes in it. You have to replace it. So the Formica, even though that's, those are not bad items, it's not a Class A product when you do that. We spend a little bit more money today on the finishes, on the carpeting and on the flooring, so that 5 years from now, 3 years from now, we're not spending a lot of money on maintenance and on turnover. That's what, in my experience, has cost us more money than anything, is a long-term ownership.
And what is the median income in Princeton?
$74,000 a year.
Okay.
Yeah. And so if you use a 30% calculation, some of the smart people say that most people spend or can spend up to 30% of their income on housing. So if, 74,000, you've got 20, what's that, about 24,000 a year that they could spend on, 25,000 a year they could spend on housing. So that's well over $2,000 a month. And even our 3-bedroom apartments don't hit that with the utilities. So I think we're priced right in the market. We're at about $1.89 a square foot, if I believe that. The market is a little over $2 a foot. So we're really, I'm not trying to forecast these where they look good. These are our real numbers. And I think they just we happen to be in a really good market at a really good time. If we were doing this in another market, it'd probably still be the same, but it really feels good around here because we all live here and we've all seen what has happened in this North Texas area over the last 5 years. So, and it's not expected to slow down in the next 10 years. So I believe we've got a good 5-year run at these.
And Alvin, if the interest rates go up significantly sharper, in terms of the exit strategy, will you be pushing out the refinancing?
I don't think so, because if the interest rates continue to go that way, that may affect our ability. It won't affect our ability to refinance. If the interest rates go up, what we may see, Pratik, is we may see the cap rate trend backwards a little bit, okay? So that means instead of having a $61 million value, we'd have a $55 million value. We'd still have enough value to refinance from the construction loan. And let's say worst case scenario, we did not have enough to pay off the equity in 3 years because our refinance was shrunk to amount to where it just could pay off the debt. Then that means we've definitely got great cash flow because our debt is a whole lot lower. So we get not only our returns, but we get a big percentage of cash flow because we've got a lot less debt on the property. So we'd still be getting our returns. We'd still be maximizing our return on this. And then if it took 2 years or 3 years for the market to swing back up, because it always does, then we refinance at that period. So we'd still be within a good timeline of our 7-year period and still hit those returns really well.
Okay, thank you.
Yes, sir. Rashmi, you have any questions?
No, Alvin, I'm really good. I mean, thank you so much for taking all the time and explaining all the, explaining everything. I actually drove to Princeton today and I took pictures of the of the neighborhood also. I mean, where the apartment is coming up. It looks really exciting. The location is so perfect. I mean, we are not only, going in there and building an apartment. Actually, we are bringing so much value to the city and to the people who work there and who live there. Because recently, like I said, I had a surgery and I met so many nurses who live in Princeton. They
Yes.
live in Princeton and they come to Plano for work. So it's a good population, over there, who definitely need housing. And with the interest rates going up for the single family primary homes as well, not
We'll have
many.
more tenants.
Yeah, there is more demand for apartments going forward, because not everybody can afford single family home.
That's correct.
And with the builders asking to pay, so much amount down on day one. I met few builders there. They're asking 20% down day one, on the day of signing contract. I mean, it's very difficult for people to afford single family homes. So apartments are the best choice, and you're building it in the right location. And
Well,
with
I'll
all
tell you,
the,
from
Mhm.
that location on the corner of FM 75 and Long Necker Road,
Yeah.
I spoke to the city inspector, and he told me that those tracts of land are about 100 acres on both sides of the street. So
Mhm.
our master plan community was 104 acres. Next door was 100 acres. They are putting water lines for 3 miles down that road. And
Mm.
every 100-acre tract for 3 miles is sold for subdivisions of homes.
Yeah.
There will
I
be
have
2
seen some
apartment
boards over there.
complexes in that community. So it's amazing the amount of people that are moving to that market. So
Yeah,
we're in the right
exactly.
spot at the right time. We really are.
True. We are at the right time. Exactly. There's so many new communities coming up there. I've already seen builders putting up their signs. So, so there's definitely strong demand, and it is it's right across to the high school, the Princeton
Yeah.
High School.
Yeah.
I'm like, wow, this is such an awesome location. So I don't think anybody would go wrong, investing in this deal. It's like, it's a great opportunity, to be honest, in this current market. That's what I would strongly recommend. With all these green initiatives and the creative way of collecting rents by offering all the services upfront to the customers. So it's like, for them, it's like, by paying $1,300 for 1 bedroom, one bath, they are able to, it includes everything, which is really good.
Yeah.
In other apartments, the base price itself is 1,300. On top of it, utilities is coming to 250. So they're ending up paying 1,500. So
That's right. That's
so
right.
here, yeah, it's a good value for money, asset also. I mean, it's really good. That's what I felt. Yeah.
I want to
Any
show you
other-
guys one thing really quickly. I'm gonna try to find the pictures of the what the development's gonna really look like. That picture on there wasn't it. Let me share my screen really quickly. This is what it'll really look like.
It looks very modern. Yeah, it looks very modern. So does it have the flat roof? Flat roof?
Yes, yes, ma'am. Flat roof.
Okay.
And the reason we did a flat roof is because we will put some solar panels on the roof that will preheat our water. So when you right now, if you go to your bathroom and turn on your water, it's going to take 5 minutes for the water to get hot. Think about having 200 apartments doing that, how much water is being wasted.
Wasted. Yeah. Yeah.
Man, when you can turn that water on, it's instant hot. We're going to save millions of gallons of water per year. And all that equates to dollars for us.
Yep. Totally.
Super excited. Super excited.
And solar investment has tax breaks as well. Plus, so that's another advantage.
They do. And I'll tell you, we'll pick up today. There are several federal and state tax credits that we will get in the amount of about $3,500 per unit the day we get our certificates of occupancy. They're supposed to take that up to almost $7,000 per unit. That would be awesome. It would double our take back. But that money that comes back to us at the certificate of occupancy just helps us with our carry costs, helps us with everything that, our interest reserve and everything. It all goes back to the bottom line for us. And so we'll have some really, really good financials by year 2 and year 3. It's going to be amazing.
Okay. Appreciate you taking time. Thank you so much, Alvin.
Yeah. Thank you guys so much. I'll have this recording and it'll take an hour or so to download, and then I can send it to you later if you like it.
Sure, Alvin. Thank you so much. Yeah. Can we all get a thumbs up?
Yes.
And thanks to Alvin. Thank you.
Thank you guys so much. I appreciate you.
All right. Thank you, Alvin.
Right.
I'll see you soon. Bye-bye. Bye.
Bye-bye.